Chapter 15 then, everybody. We're doing the owner's equity, okay? The portion. And this chapter focused a lot on journal entries for purchase, repurchase of shares, preferred shares and common shares, okay? And it's important that you remember to understand the journal entries. And again, you know, especially for those that are going to be accountants, CPAs, right? Not only working with accounting, but really being like, you know, the head of the department or working directly in the accounting department. So you guys are going to need to know a lot about journals, right? You need to understand what happens to be able to understand the journal. So if you found difficult some of those problems doing the journal entries, okay, for those that spend some time doing, I would say most likely is because you don't know the dynamic, or you don't know much about the dynamic of selling stocks or repurchasing stocks, okay? But if you understand that dynamic, if you understand what, you know, money coming in, money coming out, what's, you know, what's going in return, then you can pretty much figure it out, those journal entries, okay? Always reminding you that when you sell stocks, you receive money. And if you receive money, you're gonna debit that cash. So this is basic finance, financial accounting, basic of the basic. That's basic bookkeeping. If you receive cash, you debit, and if you pay cash, if you pay, you credit. So this is very helpful to understand the journal entries. What is going to be a debit, what's going to be a credit. And then you're going to have to figure out the differences. That's what I usually suggest you to do at the beginning, okay? And what I meant about understanding the dynamic of the stocks is that I mentioned last class, sometimes you're authorized to issue 1 million shares, but you decided just to sell 300,000 and keep 700,000 of those authorized shares in the company, right? You're not selling. Okay? You only sell 300 of it. So that's an example, which when you decided to sell more, well, let's say another 100,000 of those 700 that are left, you might have to sell for a different price that you sold the first, you know, the first offering. That's going to create what we call the paid-in surplus, right? That's what you probably, for those that did the assignments, probably got familiar with that word reading the book. The paid-in surplus is the difference between the par value and how much you sold the stock for. So that's going to create a difference in your journal as well. Let's say, you know, the stock was worth 10 and you're sold for 5, right? Excuse me, let's, you know, more real life is this, it was valued at 10 and you sold for 15, okay? It doesn't implicate that you could have sold for less, you know, depends the market. But let's make it a little bit more realistic, a little bit more friendly. You are authorized a par value at 1 or 5, and then you sold for more. The surplus that was created has to be included in the journal. So the difference in cash and the stocks create the paid-in surplus. Okay, so preparing you just to, so that's probably make easier to understand the journal entries. All right, like I said, I'm going to focus on those ones that I found more important in terms of, you know, not only for your careers, but also for what I think is going to be important for the exam. Okay? All right, so let's see. 1, 3, 9, let's see what the homework was. So classwork, I have the short problems, 1, 3, 9. And the short problems, I'll take a look in 10. 1, 3, 9, and 10. All right. But I might make just a comment here and there, and we're going to spend some time doing those exercises, especially this one here, the 17. Okay. I ask you to do items 2 and 3, but I will make a comment on item 1, which is the journal entry. All right, RE15-1, that's exactly what I mentioned to you here. Look at that, okay? Forget the numbers, forget the totals. I want you to focus on the debits and the credits, okay? Here we have the cash being debits in this most likely, because I don't have the question here in front of me, but just by taking a look in the journal entry, I'm able to tell what happened, right? And what happened here is that the cash was debit. There's a debit here of $16,000, representing the sale of 800 shares at $20 a share, right? And because you sold stocks, you made the cash in return, so that's a debit, okay? What is the credit? The credit is common stock, okay? But if the common stock was $20, then that would be a very simple journal entry, okay? Cash debit, common stock credit, move on. But because you most likely will have a difference between par value, what's par value? That's when the stock was authorized to be issued at that par value, okay? And now the stock is being sold for more than that, okay? So that difference, which will be a $15 difference on 800 shares, we credit on the additional paid-in capital on common stock, okay? So that's the basic entry for any issuance and sale of common stock. That's actually more the sale of common stock. All right, let's see one more here. Because we have two types of stocks in any corporations. We have the common and we have preferred. Excuse me. Here is the same deal. Look, your cash is being debit because you sold stocks. You sold, okay? And the common stock, you sold 800 shares, the par value was $5, okay? And then the additional paid-in on that, I don't have the data here in front of me, but you know, the data is right here. Never mind, okay? Okay. Let me see if there's any. Okay, so this is a slightly different problem. I remember. I still want to focus on the journal entries. I don't want you to spend much time figuring out the calculation. It's not accounting. This is mathematics, right? It's the accounting that are more important, at least in my point of view, more important for this class. So if you get the understanding, the basic understanding of a journal, okay, figuring out the numbers that go in front of it, that's secondary, in my opinion, okay? Usually those problems get very difficult because they write in a way that's kind of difficult for you to get the numbers. And you're always going to have to remember that in real life, right, it's going to be quite easy to get the numbers that you need to put on those accounts. I think it will be more difficult will be remember what is a debit or is a credit rather than what is the total, okay? Because this one, again, in real life, is not going to be this way. You know that, right? I mean, in real life, those numbers are much, much easier to gather, okay? All right, so here again, you're going to debit your cash because you sold it, and then you're going to credit everything else, okay? If there's a difference between the par value, you add on an account called additional paid-in capital. All right. Let me see how long. I have 15 minutes into the class, not bad. Let me keep on going here. Again, stop me at any time if you have any questions. Okay, that's not the one I want. So I have 9 and then I have 10. Okay, very quick on 9, and I regret giving you this question. Actually, yesterday when I was taking a look, I said I didn't mention much about compensation expense during my lecture. I even told you that I was not going to be too big on compensation expense at this point because you're going to have a chapter, a heavy one by the end of this course on pension benefits. And on pension benefits, then I will address a lot on compensation expense. So I didn't want to spend much of our time on compensation expense now, but I think I remember, again, if I had seen this before, I would have canceled. But I gave in previous classes this particular problem here, just to expose you, or expose them, in this case now you, to the understanding of compensation expense can be done in the format of stock options, okay? So here is, and you don't need to pay that, the exercise of those options doesn't have to be in the year that you paid, okay? And sometimes you can forbid the employees to cash all those options at once. You might have to have a waiting period or a vesting period, etc. Okay, so again, I'm not gonna much time here. I don't have the data of the problem, but again, this is the answer for those that did it. Take a look, and if there's anything that you wanna ask about it, I'll be glad to mention. But like I said to you, it's not something that will be critical, and I don't have any questions on this exam. You will have on the final, but not on this one regarding compensation expense. All right, 1510, I want to make a comment here. It seems to me, let's say, is a preferred stock at Parquet, is a situation with preferred stock. Is a conversion. Okay, I want to talk about the convertibles today. That's the topic of earnings per share. Okay, we're going to talk a lot about converting an instrument into stocks. Okay, in this case, it's actually switching stocks for stocks, if I'm understanding correctly. Correct me if I'm wrong, because again, I don't have the data, I don't have the problem itself in the book. I have the answer here, but just taking a look in the answer, it seems that you are converting some preferred stocks, common stocks into preferred stocks, meaning you giving some common stocks and receiving some preferred. Okay, that's possible. Again, this is all decided by the company, right? So the company decided if they want to do preferred stocks, how many, to whom they're going to sell, common stocks, how many, etc. Okay, reminding you that preferred stocks usually have no vote. So you could have like a large chunk of preferred stocks, but you have no say on the decisions, because that's one of the features of the preferred stocks, no voting rights. Okay, but the good feature of this preferred stock, otherwise why would you get one, right, is that it's supposed to pay dividends every year. And I say it's supposed to because sometimes the company cannot pay dividends. But in that case, they will accumulate it and eventually being paid. It will be paid to the owners of the preferred stock. So preferred stocks has dividends or pay dividends guaranteed. They just not guaranteed they're going to be every year, but they will be guaranteed, but no voting rights. Common stocks, on the other hand, is precisely the opposite. You have the voting rights here, but you do not have a promise of dividends. However, you will most likely common stock at one point will pay dividends because if it doesn't pay dividends, the voting rights not enough to keep people holding the stock in their as an investment, right? Because think, you have, let's say you have 1,000 shares of Microsoft. What is your voting power? What is your decision power at Microsoft because you own 1,000 shares? Nothing. You have no decision at 1,000 shares, okay? You're gonna have to have way more than that to be able to call some shots on decisions. So therefore, why people buy common stock? They buy common stock because they expect the price to appreciate and they expect it also that may pay dividends, okay? So that's pretty much why people buy common stocks, not really for the voting rights. But although you can, if you combine forces with other investors, okay, and you do a proxy voting, which is allowed someone to vote on your behalf and you're joining forces, then maybe you can have some decision making or decision power towards the future of the organization. Other than that, 1,000 shares or even 10,000 shares not going to take you anywhere in those, if we're talking about one of those large corporations. All right, so here is it's again, this is a number problem again, okay? Because on the, excuse me here, on the journal entry, it's pretty much the same. It's really what you're getting and what you're sending. You're getting preferred stocks, okay? And you actually switching for the common stocks for that. So in other words, you don't have the common stocks anymore and you have preferred stocks. It's like receiving money and paying money. If you receive money, you debit. So debit what you received and credit what is actually or how you paying for that, right? Or, let's say you're receiving an asset here and now you're paying with another asset, for example, okay, just for you to see it. So a debit and credit. And then any differences will be on the additional paid in, okay? So if there's any difference between the par value and the amount, it's an additional paid in. It could be a debit, okay, when you receive, and will be a credit when you actually are paying for. Okay, there you go. Again, if you had a hard time here, probably wasn't the numbers. And again, if you have a question, let me know. And then you present me with the problem, put it on the screen, and then I will help you to get those numbers. But right here, like I said to you, I want you to focus on the journal entries, okay? And look at this journal entry, and by the way, it doesn't have to be identical to this one. If you put preferred stock, okay, or stock in parentheses, preferred, that's fine, you know. Additional paid-in capital, and you put in parentheses preferred stock, okay, or preferred stock, additional paid-in capital. Again, right? Here, you don't need to put the word conversion. Additional paid-in capital from preferred stock conversion. Okay, so just put additional paid-in capital from preferred stock. The conversion, you're going to put it on a comment, okay, if it's the case. All right, let's move to the exercise again, unless you have any questions. Okay. And then you can jump to chapter 16. Oh, I was taking the wrong one. There you go. Exercise 1, 12, 16, and 17. 1, 12, 16, and 17. All right. One is journal entry. Okay, so just take a quick look here. Check against your numbers, make it a little bit more visible, because now the exercise, and the exercise are candidates for the exam, not much the short problem. So again, forget the numbers for now and focus on your journal. Debit cash, credit the common stock, credit the paid-in surplus, or the additional paid-in, which is also could be paid-in surplus. But additional paid-in, let's focus. Let's use the same word that is in the textbook. So the additional paid-in capital on common stock will be a credit in this case, again, because you are receiving the money. You will see in future journal entries when you repurchase the stock, then the additional paid-in will be sometimes on the debit side, not only on the credit side. Okay. All right. And look at that's the example I was giving you before. When there's no difference between the par value, okay, or there's no par value whatsoever, then you just need to do a very simple journal entry, which is a debit on your cash and a credit on your common stock. Okay, that's as simple as that. Okay. All right, so I don't think this one should be a big concern. Okay, you're going to have to face few journal entries on in your first exam. Okay, which will be next week actually. So I'm taking this to remind you that the exam will be posted on the Tuesday after class. And you're going to have 2 days to complete that exam, right? 2 days is enough because it's an exam, it's not an assignment. And that's an exam that I usually give in a classroom that takes then an hour and 15, an hour and 30 minutes, okay? So 2 days is plenty of time. So what I do is on Tuesday, I'm going to go over the assignments that I'm going to give it to you this week, okay? I'm going to go over both assignments, even though some of you might just do one if you attend the webinar, but I will go over both the assignment, and then the remaining portion of the class, I'll give a quick review, focus on certain problems that we did in class that could be candidates for the exam. Okay. All right. Let's see if I want to say. I want to see if I want to start with the 17 right away, because that's a long problem. But I think I'm in a good shape here. So. Yeah, so 17, I want to make a comment because we have something called Treasury Stock, okay? Treasury Stock, if you see in the balance under the owner's equity statement, it's usually a negative, it's like the accumulated depreciation, right? It's a counter account, right? It has a debit balance, but we report it under the owner's equity, which usually has a credit balance, so create some kind of what we call a counter account. But what I want to know more is that treasury stocks are the ones that where the stock stays that you can you can take it from there to sell more, or when you repurchase stocks, you can put it back in the treasury stock So treasury stock is a situation, a scenario that usually happen when you actually repurchase your stocks. Okay, that's why cash is going to be always credit when you have a scenario with treasury stocks. Okay, now once you get out of the treasury stock and put it back in the market, then look at what happened. Is a credit. Okay, so basically the journal entry here goes back to the principle I always said to you. Okay, if an asset leaves, you credit. Okay, and something of value, I'm not going to call this an asset because it's not an asset, but something with value comes in. Okay, you debit. Okay, so that's the scenario here. Okay, here we receiving cash, and then we sending stocks in return. So kind of like selling stocks. So as a basic sale here, journal entry. All right, so this was not assigned to you, but I just want to mention that to you because you're assigned to do 2 and 3 of 15, 17. Okay, and then I'll go back and I want to talk about this one here, which seems annoying. And there is, I think there is a question in your exam regarding the owner's equity statement or total contributed capital. It's not a difficult to understand, but this deserves a comment. But before that, all right, that's something that I gave this in purpose, and I said this might be, in my opinion, the most difficult problem, because owner's equity, it's not easy to build, right? It's not easy to especially for students, because I think it's our fault, the instructors, in a way, not completely, that we focus too much in assets and liabilities in a lot of courses of accounting, and then you forget to break down the shareholders' equity more often in the classroom. I think we start with service business like a laundromat or a very small place. So usually what is the owner's shareholders' equity of that company, right? So that's why we don't talk much about shareholders' equity. When you move on to the corporation level, which we're now, then we have room to talk about the real shareholders or owners' equity, okay? And you can see here a big example. This is the answer for the problem, okay? If you get the number here, 593,700, great, very happy, okay? It doesn't matter how you organize your numbers, as long as you got the 593,700, means you understood the components. And if you didn't, okay, then my take is that could be on the treasury stock that I said to you, remember, is a counter account. So it's like the accumulated depreciation, it kind of reduces the value of this owner's equity in this case, okay? So if you put as a plus, then your numbers will be different, okay? So let me break this down for you nicely, because I think that's an important thing to retain from the intermediate accounting too, is that you are comfortable looking at and understanding an owner's or total shareholders equity section, right, of your balance. If you are very comfortable reading, what is in front of you here and make everything make sense, that's good. That's you got something important out of this class, really important. All right. So we divided the owner's equity. Well, let me put it this way, right? Honestly, there are 3 components, in my opinion. 3 components, right? Most of the time, we say we have 2 components on the owner's equity section. I'll explain to you. Component number 1 is always what the capital, the contributed capital, the invested capital, or the stock capital. So capital for short. That's component number 1. In every owner's equity, you're going to have the capital. It's the investment that the owner made. Then you're going to have a second account, which is most likely present in every company, which is the retained earnings. Is the profit and loss, the accumulation of profit, that's they kept it in the business as the business keeps on growing. So there you go, 2 main accounts, the contributed capital and the retained earnings, and that's the ones we're here. So why did I say 3? It's because we have a component called Other Comprehensive Income, or OCI, okay? And OCI is an important, I'm pretty sure you've seen OCI on Intermediate Accounting 1. If you have taken that class with me, you definitely seen, because I spent some time on OCI. I think it's an important component. But it's not usually often the OCI is present on this owner's equity, okay? And OCI, other comprehensive income, I mentioned in intermediate accounting, but I actually work more on advanced accounting. So you're not going to see anything on OCI here, other comprehensive income. So your owner's equity here is going to be basically two components, capital and retained earnings. Look at that. See, now gets a little easier, huh? Because now you say, okay, only capital and retained earnings. So what is this whole thing here? Oh, that's because all the capital, was contributed, or the capital was added in different periods of the life of the company. So the capital varies in amounts. So that's why you're going to have the additional paid-in surplus or the additional paid-in capital, okay, regarding the sales of stocks at a different price than the one that was authorized per value. Okay, that's all. So that's what we have here. You have two types of stocks, preferred and common. And then you have all the additional paid-ins, okay? And you might have an additional paid-in from treasury stock as well, because remember, what is a treasury stock? The treasury stock is an account, okay? It's not a stock, really. It's an account. Preferred and common is a stock, right? You can buy and sell, but treasury stock, it's just really, in my opinion, is more like an account where the stock stays in, right? And because you're gonna actually go in the market and take it back and, or release from the treasury stock account and back to the market, those stocks, okay, they will be also generating an additional paid-in capital, right? So you're gonna have the three types of paid-in capital. So if you have a list, take all the paid-in capitals, add, okay, add with the par value of the capital, and that chunk is what we call the total contributed capital. There you go, 482,700. Add that to your retained earnings, and that supposed to be your owner's equity. But because you're going to have treasury stock or not, but in this case you did, and treasury stocks is like accumulated depreciation, right? It's a counter account. You minus from that amount, and that's your total shareholders' equity. And if you're wondering how to get the retained earnings, this is basic financial accounting, okay? It's the basic retained earnings is previous retained earnings plus profit minus dividends. I imagine those are the three numbers that we have here, but that's the basic rule, right? You take your previous retained earning, add more profit that you want to retain, right? Actually, here you add your profit and minus your dividends. That's what we have here. Okay, so you're adding 20,000 out of 30,000 back into the company. Okay, you're going to learn in financial management. That's what you call the flowback number. Okay, the dividends we call the payout, and when you take in the profit that you put it back, we call the flowback. Okay, it's a very important concept in finance. They're gonna, if you're not taking that class, I suggest you take that class. Most of you will have to take that class. All right, friends, so this is, I want you to understand and I want you to feel comfortable with the shareholders' equity, okay? Because this will be in your exam and you'll be tested on that. So the idea is that there's only two components there, but you're breaking down these components in subcomponents, then make this whole thing a little messy, I would say, okay? And you also have to remember what retained earnings are. Okay, or what is the basic retained earning equation? Okay, the new retained earnings equals previous ones plus profit minus dividends. All right, question number 3 is, I asked this question because I know I didn't mention in class, but I told you in the beginning of the course. Every now and then I'm going to throw you some questions from homework that I either didn't have time to address in class or decide not to. So you can do it, and then we address that during the feedback. So here, friends, we have a situation where a company is not using the GAAP, right? The American, the United States codes of accounting, right? The general accepted accounting principles. They're using the International Financial Reporting Standards. So because of that, they are allowed to do certain things that you're not, and vice versa, right? Because it's not identical. They will try to get there. I don't think we ever will. It's been going on for such a long time to try to see if they can make those standard of accounting identical, no matter where you are in the world. It's not there yet. So that's why you are an accountant. If you're an accountant for an international company, you're going to have to do some extra work at the end of the year to consolidate your statements into the currency that you need to present. That's advanced accounting. So we're not there yet. So in advanced accounting, we're going to have to we're going to have to translate the numbers from one currency to another, right? And you're going to have some implication on exchange rates. So this is going to affect the value of the company. So that's some heavy stuff waiting for you in more in future accounting classes. Okay. All right. But if you are working in a company like that, then you're going to have to make some adjustments before the translation. And the adjustment is that under the International Financial Reporting System, okay, revaluation, okay, could be, it's not going to go to the income statement. So any type of revaluation, I don't know if there was an inventory revaluation or some kind of asset revaluation here, you're allowed to put that under the shareholders' equity, okay, as you're going to see here. Okay, it's called revaluation surplus. There you go. Differently than us, we don't put that on the shareholders' equity, okay? Because sometimes we're not even allowed to do revaluation in under the International Financial Reporting System. We are, they are, okay? So that's it. This is just a comment on that. Again, if you did this problem and you got it, if you nailed, great, great. You're in an excellent shape. I take my hat to you because it took me a while when I was learning this to get comfortable. I was just, honestly, I just became very comfortable with shareholders' equity when I became an auditor and I started working as an auditor for a while. Then I thought, okay, now this makes sense. But reading a chapter in the book and try to put together an owner's equity or shareholders' equity, as you see it, doesn't seem to me an easy task. So that's why I told you I accepted work that's not 100% correct. Once you get the answers and you see, oh, I missed this, I missed that, you still get full credit for the assignment. Okay, the idea is to try, then we give the feedback, and I think that's how the learning happens. All right. So this one here, I actually moving on. Okay, it's an important problem for you to study for the exam, which is next week. Okay, it's going to be posted next Tuesday, and you have until Friday, the end of the day. It's actually more than 2 days to do it. And most likely, I think, and of all the important topics here, I think we're in a very good shape. I think it was a good review. Nobody asked any questions, so this means you're either are very, very comfortable, or actually there are 3 options: not comfortable at all but don't care, or not comfortable and don't want to ask any questions because you just don't want to ask any question. Yeah, the deal is still the same for today. You stay until the end when everybody's dismissed, and if you want to ask your questions by then, totally fine. Okay, I always can spare 15, 20 minutes after class, not a problem. Good. All right, then say goodbye to chapter 15, and let's do now chapter 16. Okay. For chapter 16, I will share an Excel with you. Okay. Right. I'm going to take the attendance now. 1, 2, 3, 4, 5, 6. I think I'm missing one of you. I'm going to take an attendance quick before I forget. Done. All right, let's keep on going here. I'm going to share Excel first and then a PowerPoint for chapter 16. We have half an hour, plenty of time. I think it's a better chapter. I like it better than the previous one. Let's see, there you go. Excel. Hi friends, so Excel should be in front of you now, okay? There you go. And I summarized the entire chapter. Oh, one little typo here. 16, not 15. There you go. So chapter 16, earnings per share, okay, in earnings in general. So I summarize here in 5 important points for you to understand. That's important for this chapter, okay? And you're going to be tested on the classwork and homework. Okay? So we're going to start with the problem is the chapter is earnings per share. Okay, let's start with the concept of earnings, right? So earnings is your net income here, right? In this case, is at the end when you pay all the expenses, you know, took up the costs, etc. The leftover, that's your earnings, right? Now in the market, in the financial market, okay, earnings are not reported in the dollar amount, okay? Because sometimes it doesn't make much sense. You know, could say, you know, first of all, some of the earnings are in the billions, right? And some other earnings are in the millions. So again, you're going to be reporting 5,334,700,000. You know what I mean? It sometimes gets difficult for you to communicate when the numbers are large. Okay. So in finance, we prefer to communicate in percentage. Okay. Or enough per something, right? Per something. Okay. That would be like a per share, right? Or a per hour, something like that, right? So because that's easier to communicate rather than you say a dollar amount. For example, I invested, let's say I tell you that I made $1 million on the stock market last year in profit, $1 million in profit. Is that good or bad? It might sound good. $1 million is not bad, but if I invested $1 billion and I made $1 million, it's a small return. Okay, so that's why it's better to communicate in percentage. I can say I made 1% in the stock market last year, or I made 5% or 10%. Then it's more meaningful because I make X percent more, that I invested. Right. And here's going to be the same deal. Instead of communicating the earnings in the billions, right, or the millions, or maybe trillions, who knows? It's better to take that amount and divide it by the number of investors, which you call shareholders, right? So the number of shares. Okay. So imagine that, you know, each share that you sold, it's in the hands of one person, right? So each person will get that amount of the earnings. That's what the earnings per share is. Obviously, one person might have, you know, hundreds or thousands of shares, so he gets that number of shares multiplied by the earnings per share. Okay. If the company decided to pay all the earnings in dividends, which sometimes is not the case. Okay, so that's the concept of earnings here. So earnings per share is nothing more than the total profit, the clean profit, the net profit divided by the outstanding shares, not the authorized shares. Okay, that doesn't make any sense. It's on the outstanding shares, the ones that are out there in someone's hand. All right, good. I hope that definition is clear for you. Next one, retained earnings, already defined during the lecture. Okay, the retained earnings is the place where the portion of the profit gets retained. Okay, so the basic equation of the computing retained earnings is that, you know, I call that the RE, okay, T1. Okay? It's always equal to the RE T0, okay, plus the earnings minus the dividends. Okay. So the RET1 is the retained earnings at time 1, and the RET0 is the retained earnings at time 0. So just to give the concept of before and after here, okay? Plus the earnings, okay? And the earnings would be at T1, okay? If you want to stress that. And your dividends will be the ones paid at T1, okay? So previous retained earnings, okay? Plus the earnings, minus the dividends, that gives you the new retainer. All right. Next, which is important, and then we're going to go in the slides because this is just a brainstorm. Okay. we have the types of dividends that a company can issue for you, or in payments of dividends, excuse me, not for you, but through the shareholders. Could be the most common one is the cash dividend, so you get a portion in cash, okay? But you could also get a property dividend, okay? Remember on chapter 13 we said available for sale. So you could get some kind of a bond or stock, okay, which is not very common. You could get inventory as a payment of dividends, okay? So not necessarily cash. You can have a dividend script that's more like an IOU of a dividend, and you can have a stock dividend. Okay? Instead of getting money, you get more stock in the corporation. Okay? So those are the types of dividends. Okay? Now, during the lecture, during the slides, I mean, of course, it's a lecture right now, right? When I'm showing the slides, I will show you more examples of each one of those, right? And when this happens, right? And the implications also of stock dividends as well. Okay, continue here. We have also the concept which I already mentioned, but now I'm going to go a little bit beyond on the concept of earnings per share. Okay, so this concept of earnings per share, or EPS, okay, you can have what we call the normal earnings per share, and then this is a very, very important concept here. We have the diluted earnings per share. Okay. That's very important for investors. Okay, very, very important for investors, because one thing is for you to present the earnings per share, and then the other thing is presenting the diluted earnings per share. Okay, I don't know how many of you saw the movie The Social Network, about the story of Facebook, and there's a very, very interesting scene in the movie where they precisely talk about the dilution of earnings per share. It was the guy that actually got the short stick in the end, right? The one that helped to found the company, but then they kick him out. They kick him out by diluting his shares. Okay, I'm not going to go in details how this happened here because it's out of the scope, but the movie addressed that. Okay, so it's very important for you as an investor, if you have shares, to find out if those shares are going to be diluted. Means, for example, if you have 1,000 shares, right? There's only 1,000 shares in the market of that company. This means that the entire earnings, or excuse me, the entire dividends are going to be divided by the 1,000 people. I'm not going to talk about dividends now to not confuse. So let's imagine that the company is paying off all the earnings in dividends, okay, to make it. So take the earnings and divide it by 1,000 people, give you a chunk of money. Now, imagine that, say, oh, by the way, it's actually not 1,000, it's 2,000 shares that we actually have out there, right? What happened to your earnings per share? It dilutes, it gets smaller, because now you're going to have to share with more people. So if you're a part of this 1,000 here, and then you think there's only 1,000 to share with you, and then all of a sudden there's 2,000, that's really not fair, right? And in finance, you're going to have to be fair, and you have to be fair and transparent, okay? That's why I'm telling you, someone with the credential CFA, this the chartered financial analyst, most likely will exhibit high professional conduct. Okay, so if you are looking for someone to invest money with, I advise you to check the credentials, right, of those people. So the more trustful that you can get someone, or someone more that works with an ethical manner, I think that's what you should do. Okay, and having that CFA credential. Mostly, I'm not saying that every single one. I wish I could say that, but not saying that every single CFA has your best interest. They should. That's what we swear on. But most likely, yes. Most likely, okay. All right. So that's the dilution of earnings per share. We're going to see more examples on it, and then this topic here, convertibles. That's precisely what causes the dilution of earnings per share. For example, one example here, convertibles. And I already mentioned that in the previous, actually not in the previous chapter, but when I was doing the feedback on the homework, the convertible, you could have some bonds or even stocks that can be converted into other stocks, okay? So the most common one are the convertible bonds. A bond is an IOU, right? So IOU, you give the money to, this chapter 14, or chapter 13, depends if you're an investor or issuing the bond. But this is an IOU, so one party receives money, right? The other party will receive interest, and then the principal back at the end, okay? So that's a bond. Now, the investor, right? Chapter 13, right? Now you're an investor and you purchase the bond from the corporation. You might have a clause there under the indentum, not the bond indenture, that at certain point, the bond could be converted into X number of shares of the corporation. Right? And this is material for another class, but we teach it in what is the most convenient time to convert the bond into shares of stock. Obviously, is when the value, the number of shares that you're going to get multiplied by the price of the stock in the market will be higher than the price of the bond at that point, right? But that's not important here. What's important for you to understand is that when you converted a bond into stocks, then you're going to dilute the earnings per share. You're going to increase the number of stocks because now this person that had a bond does not share profit. Now this person decided to switch the bond for stocks. Now this person will share profits. So that's the implication of convertible assets, convertible financial instruments, okay, that can increase the number of shares and then can cause investors to be quite upset, okay, because they're going to have to share the profit with more people in case the company is paying dividends, right? That's the main idea. All right, that's chapter 16 entirely there for you, okay? Points 1 to 5, this is the most important components. Now I'm going to use the rest of that. I'm in a very good shape today, okay? If you haven't paid for the class, I would even mention in finish early, but because you paid for it, I think I'm going to have to stay until 1:15. But no problem. We always have something to talk about it. But just kidding here. I think now showing the slides will be much easier for you, okay? At least to understand. All right, so one more share now. All right, and now is the PowerPoints that I want to share here. PowerPoints, which is posted for you on Canvas. There we go. And go up, but this in the end, 26 slides, but obviously I'm not going to go over 26 slides. Okay. So I'm just going to go straight to the point here, and I'm going to make the slides in more presentation mode when I think it deserves a comment, which is the case of this one. Just waiting for the slide presentation to start. There's a delay. And I don't know if that's related to my internet or laptop. Most like internet. All right, friends. So what's important here is, and believe it or not, this is material for, I don't know if it's CPA exam, but definitely if you're going to become a stockbroker or a stock trader, and you need the license, you need a Series 7, for example, to trade on the New York Stock Exchange, then you're going to need to know a lot more than accounting only, right? And this is one of the topics that, believe it or not, it's very testable, right? They give you a scenario and they ask you who is entitled to receive the dividend of that stock. Typical question of a finance exam. And you need to remember all those dates here, okay? So this is not much accounting related, but I think it's important, especially if you're going to become an investor, okay? And because this is related, accounting and finance totally related, I want to spend some time here, okay? Declaration, see, remember the company doesn't have to pay dividends for the common stocks, and doesn't have, I mean, if it doesn't have money, it's going to have to skip the dividend from the preferred stock. But it's not a liability for the company until the company declares the dividends. We will pay dividends at the end of the year. Boom. That's the declaration date. At that day, a journal entry here showing that the company now has a liability. What is the liability? Dividends payable. That's the liability. Okay, they have to pay those. They have to pay those dividends. Okay, so what happened is that I own the stock when they declare the dividend. I say, great, all right, so I will get the dividend. But what about if I get in financial distress a few days later and I have to sell that stock, and I sell to another person? Who is entitled to get the dividend? Me or the other person? Okay, and it's not as simple as, the other person. No, because dividends are not something that get attached to the stock. There's some complication between date, and the corporation needs some time, etc., to get a list of who is entitled to get it, who is not. Right? So then we have what we call the ex-dividend date, which is the last day which the stock trade with dividends attached. Meaning, if you had the stock at that time, the dividend was yours. Okay, if you sold it, right, then you sold it for, usually when you sell the stock that doesn't pay the dividend, you sell for less than was if you had a dividend, right? So the ex-dividend date determines, that the stock after that date doesn't sell with dividend. Whoever owns the stock, purchased the stock after that date, does not get the dividend. The person that had it before will get it. Okay. The date of the record is when the corporation creates a list of who will get paid the dividend, and then the date of payment is the payment itself. Okay, so that's very important to remember. And believe it or not, the typical question in financial exams is they tell a little story. They tell you the company declared dividends at this date. John had the stock on this date. Figure out who will have the dividend, and they have the alternatives there. Right? All right, so that's important to comment, so that's what I did. There you go. The ex-dividend date, the stock will stop selling with dividends attached, meaning you can purchase the stock after that date. Okay, you that have the stock could sell the stock after that date, but that stock will go without the dividends that were declared, okay, for that year. Then following year is a different story, okay? That's the data record. Right. So this is the journal entries for you, okay? The data record is not a journal entry, it's just a list. But the date of the ex-dividend date is also just a date. But the two dates that deserves a journal entry, okay, is the declaration when you create the liability. So your retained earnings goes down, and retained earnings, you have to remember, goes down by debits, and your liabilities will go up by credit. So debit retained earnings, credit the liability, okay? And then, okay, the date of the payment, right? You're going to reduce your assets because you're going to have to pay cash, right? So you're going to reduce your assets, and of course you reduce the liability because you don't have it anymore. It's like paying an accounts payable, right? So that's the journal entries are simple, right? Is one to record the liability, and the other one to pay the liability. Done. You don't need to be painful to do one by one. You just do by the total, not by the dividends, the investors that receive the dividends. Of course, you should have that document somewhere showing who got and how much, right? And when. All right, cash dividends is the simple one, is when you receive the cash. I already mentioned that, so we can move on a little quicker here. I have 10 minutes, plenty of time. All right. The dividend distribution, this deserves a comment here. I think that's important. Because you can get the portion of the dividends, but if the company declared more, right, then declared more than what you were supposed to get it, then that one has to be allocated proportionally. Okay. For example, here we have on this slide before, I think I showed. Look at that. So 10% cumulative preferred stock with a total par value of 20 and common of that. Look at that. Cash dividends of 9,000. Okay, that's the total. So that's the liability. We're going to pay 9,000. And we don't own any dividends in the past, meaning the 9,000, nobody from the preferred stocks actually need to be paid for non-paid dividends in the past. That's what's written here. Okay, so this is, let's starting fresh, $9,000. Okay, so let's say, okay, 10% dividend is stated when you purchase the stock that this stock pays X% dividend. So you get 10% on the stock. Okay, so you're gonna get not par value of 20. You get 2,000 on the preferred, and you get 3,000 on the common. That's give you 5,000. Okay, you have $5,000 paid because that's what the company had stated when you issued the stocks. However, the company decided to pay more. It's possible, right? It's actually great when they do that. So that gives a very good vibe, a good sign to investors, right? Not a very. Let me rephrase that because I don't want to be exaggerated, but it's a positive sign usually when the company starts paying dividend consistently, and sometimes more than he promised, right? But this could be alarming as well because the company could be just like phasing out. But usually, at least I like it when I'm promised a certain amount of dividends and I get a little bit more. All right. So if you promise 5,000, you paid 5,000, and you decide to pay 9, means you have 4,000 more. Okay? 4,000 more to allocate it. And this is not 50-50. It has to be allocated according to a certain criteria. In this case here, the criteria was 40-60. So they take the 4,000, allocate it that way, and that's the total pay. Just a comment here. I doubt you're going to have to do any problems like that, but this is just to say that the company can pay more, and if you pay more, it has to be proportionate allocated. Let's see what else. That's the property dividends that I was mentioning to you. Okay, so you can see the property here is investment securities. Okay, remember they're available for sale from Chapter 13. You can take some of those and use it to pay dividends. I've seen also paying with inventories. A company that has large inventories, that is a useful inventory. Okay, and why not pay with your own? Use a portion of the inventory to pay dividends. Imagine talking about here. Let's say an example here. Company that makes works where the raw material that they need are like diamonds and gold, for example, right? If that's the raw material that they need to make their products, I wouldn't mind to get paid with a portion of that inventory, right? Getting a portion of gold or diamond and then sell in the market. So again, it's possible that you can have some kind of inventory that would be attractive to your investors, and they wouldn't mind getting paid on that. And say most of your investors are farmers, and you actually have a large inventory that you can actually would be preferable. So again, property dividend, it's not something that say, oh, the corporation is doing so poorly, now they have to rely on property dividend. Not necessarily, right? They might be even preferable in certain cases. All right. Scrip dividends, right? So look at that. A corporation may have good retained earnings to pay the dividends, but not much cash to pay a cash dividend. It's possible, right? Retained earnings, right, in cash doesn't have to agree on the total, right? So in that case, if the company decided to do it, right, then it should complement with some scrip dividends. Is this case? Right? It's like a IOU type of thing, right here, a promissory note, right? Pay dividends at some future date. So this means that it creates some kind of okay, I cannot pay you now, but I'll definitely pay later. So then create an obligation here, right? Remember, common stocks, the company is not obliged to pay. But once they promise that we pay, then it becomes a different story, becomes a liability. That's a declaration. Look, this comment here, scrip dividends are rare, obviously. Stockholders don't like it, and it's a bad message for the company. Okay. because doesn't have enough cash to pay the dividends. Why did you declare dividend? Because you're forced to declare dividend. Then if you declare dividend and you don't have enough cash, means you're not doing that great. So that's a negative vibe. The stock can actually probably crash in the market. So again, you're going to have to avoid those things. All right, stock dividends. So like I said to you, it's a dividend paid in the format of stocks. All right, friends, I have a couple more minutes, and I want to go to the earnings per share. Okay, the concept of diluted earnings per share, right? When your earnings per share goes down. First of all, one thing very important in finance, it's called ratios, right? And I do that on intermediate one a little bit. I also do in financial management ratios. One of the important ratios in finance is called the PE ratio, like a profitability ratio. Is the market price of the stock divided by the earnings per share, this number that we just showed you, right? What is earnings per share? Is the profit divided by the shares, gives you a number. Now, if you take the market price and divide it by that number, that gets what we call the PE ratio. That means how many more times the current market price is trading above the earnings per share. So let's say the market price is $10 and the earnings per share is $1 per share. So the P ratio is 10. This means that the price is 10 times more than the earnings. Is that good or bad? Well, when this number is very large, okay, let's say 100 per 100 times, then there's some market speculation that these earnings are going to increase a lot in the future. So they're betting now, right, paying a larger, a high price now because they're betting that those earnings are going to increase and they're going to be able to share those earnings, those higher earnings, and they also think that this happens, the price of the stock will go up much further. So that's one way to explain the ratio. But when the ratio is too low, the price it's pretty much similar to the earnings, right? That means that the market is expecting or not expecting those earnings to be high or to be consistent for a long time. There's some kind of issue going on. That's what usually the ratio shows, okay? But it's just a ratio, so called the PE ratio, okay? So the larger this PE ratio, the more expectations the market has for a growing on those earnings. And it could be true, right? Because the market as a whole, it's very functioning, right? There's, so usually the PE ratio is a good indicator. All right. You're going to learn this on financial management, okay, if you take that class. We're using a method to compare companies there called the comparable method. So what we do is we take, for example, the PE ratio of 3 companies and you compare the PE ratios, usually in the same sector, to see which one is doing better. All right. And I'm approaching here to the end here, okay? I'm consistently checking my clock, my watch, because I cannot see my clock on the computer because I have these slides on. So 1 more minute. Give me 2, please, okay? Because this goes back to that diluted earnings per share. So remember, what is a DEPS or diluted earnings per share? Is when the company has convertible securities or convertible items that stockholder, the investor holding those instruments. That's the word I was looking for. Those financial instruments the investor is holding, they could become stocks. If the investor decided to convert or could convert, that will change the earnings per share, okay? So the earnings per share, if the company is very large and has a lot of items that could become stocks, they must report the diluted earnings per share. I'm going to finish with that slide. Okay. So the diluted earnings per share, okay, is you take it, if there's any change after converting those stocks, after converting the bonds into stocks, after converting the preferred stocks into common stocks, after converting warranties into stocks, okay? How much more money was in for the earnings, put it on the numerator, added to the previous one, I guess, right? And also how many more shares you're gonna have. Put it down here and recalculate it, and that's your diluted earnings per share. Usually it goes down a couple cents, right? But if it goes down severely, it was $1 per share, and now after this becomes 50 cents per share, then investors are not gonna be very, very happy, right? So that's the problem. All right, friends, I'm right on the dot here, so I'm gonna finish the class. I think it was a good class. Although I didn't hear much from you, I felt that the topic actually went nicely, okay? It was not too difficult. Anyhow, so I'm going to dismiss the class. So please remind you, if you want to get, again, you don't have to, but if you want to get one free, one of those assignments, you choose which one, then you have to register for the webinar. It's Thursday at 4:30 to 5:30. And then on the assignment that you decided not to submit, send me some kind of proof that you are attending the webinar and that you get credit for the assignment. All right, I'm going to stop sharing. There we go. Okay, so the class is officially dismissed. Have a good day. Have a good week. I'll see you next week. All right, this concludes week 5, Intermediate Accounting 2. Bye-bye.